All right, let's discuss those tariffs a bit more. And this is a good segue because we're going to talk about the chances of a recession. And we know that Dollar Tree and Dollar General both could outperform if that is in fact the case. Joining us for the conversation is Paul Gruenwald, Chief Global Economist at S&P Global Ratings. He joins me now at the desk. Paul, thanks so much for being here.
Great to be here.
So we certainly know the market impact so far of the tariffs, but I want to talk about the economic impact.
Right.
Obviously, there's still a lot of uncertainty in terms of what we actually will see in addition to what we already have right now. Is there negotiation? Could there be even steeper tariffs on China? We heard President Trump threaten. But what do investors need to know at this point about the economic impact of these tariffs?
Yeah, well, we're watching exactly that, right? We had this seismic shift in trade policy. We had the market reaction. And now what we're watching in my team is this going to translate to the real economy? We already had a slowdown this year, right? We had the soft landing as our baseline. The question is now, is the uncertainty and all the tariffs and all the the volatility and then the wealth decreases from the stock market correction, are those going to spill over? The key nexus to watch is consumer spending in the labor market. That's been hyper resilient since the peak of COVID a couple of years ago. If that starts to crack, then we're going down the road for a recession. That's still hanging in there, but that's the key thing to watch.
Well, to your point, recession has entered the conversation more and more. We're seeing several people up their chances of recession. I think Goldman Sachs is at 45%.
Right.
We heard BlackRock's Larry Fink at the Economic Club of New York say that most CEOs he talks to would say we're probably in a recession right now. What do you think about that?
That's a little bit premature, right? Because the recession is a real economy thing, not a financial economy thing. So we would need a broad-based, significant downturn in activity. I don't think we're there yet. We would agree with the assessment that the risk of that has gone up. We did our quarterly forecast around 2 weeks ago, which we're now refreshing. In that one, we had the recession risk in the U.S. of about 35% over the next 12 months. That's almost certainly going to go up after what we've seen in the last, let's say, week and a half.
Okay, so 35% chance before the tariff, the sweeping, steeper than expected.
Right, but we're not ready to make the call as recession as our baseline. We're still in the camp where the recession risk is rising, but we're still in a significant slowdown rather than going full on into the recession call.
Okay, but that will change.
That is to be continued. Right. The risk to that, tariffs continued volatility, cracks in the labor market. Those are the things we're watching.
Okay. In terms of the economy right now, though, in terms of what the data shows, obviously the jobs report that we got on Friday is backward looking, but it was, reflective of a solid labor market. Are there any recession signals flashing right now other than what could be the impact from these tariffs?
Well, the tariffs and the market volatility, again, we had this slowdown. We're probably going to have a very bad print for Q1. We had some bad weather in January, and the well-known Fed nowcast, how the Atlanta Fed is tracking close to zero. But we still think by the end of the year, we should be in kind of the ones. We started almost 3. So we've got a pretty steep deceleration of activity, but we're not really ready to make the recession call yet.
Okay, and how should we be thinking about the inflationary impact of those tariffs?
This is the big question, right? So tariffs are a tax on imports. The price level of import is going to rise. The question is that an inflation rate? Is that going to continue to rise, or is it just a level thing? If it's a level thing, the Fed should be looking through that, right? Mm-hmm. They'll be looking at inflation rates, not the level of prices. And then they're going to be watching the labor market. So they have their dual mandate, right? So if we get to a state of the world where labor market is slowing, looks like recession's more likely, they might focus more on the labor market and start cutting. But right now, with inflation above 2 and the labor market looks good, we think the Fed's going to be very cautious. Maybe one cut in our baseline with an eye on, if the economy goes weaker, they would accelerate. They've got room to cut if they need to, but, if we're not slowing, they're not going to be cutting very quickly.
So the market's pricing in 5 cuts this year, so not realistic.
Well, we were here this time last year, too, for different reasons. Remember, we started 2024. We had 4 or 5 rate cuts. Kudos to my chief U.S. economist, Satyam Pandey, who made the call that the Fed was going to be very gradual in cutting rates. I think we got that one right. Hopefully, we have a repeat in 2025.
All right. Speaking of inflation, we will get CPI later this week. How closely will you actually look at that data, or does it not necessarily matter because it wouldn't yet show the impact from the tariffs?
Yeah, it wouldn't yet show the impact from the tariffs. There's going to be a jump. We think the headline inflation rate's going to be 4-ish by the end of the year with the Fed's target at 2. But again, the Fed and other central banks should be looking through just jumps in the price level and looking at demand pressures in the inflation rate. That's a really tricky spot to be in for the rest of the year, so we're going to be watching all that closely.
I'm getting the wrap signal, so we have to make this quick, but President Trump was quoted as saying, I don't want anything to go down in terms of the market, but sometimes you have to take medicine to fix something. Do you look at this as an economy that has to be fixed?
We needed it as an economy that needed to land, and we had a soft landing, so U.S. growth speed limits around 2. So we thought if we could decelerate from 3-ish, which is where we've been the last few years, to 2-ish, without undershooting with a slowdown or a recession, that was the good scenario. That one's now iffy.
Yeah.
Yes.
But does Powell get credit for a soft landing if we do end up in a recession eventually?
Well, soft landing and recession are incompatible. Soft landing is when you don't undershoot, right? You sort of land.
So
right?
maybe he's taking
we'll
notes
tackle
now.
that next time.
Yes.
Okay.
Thank you so much for joining us. Really appreciate it.